Welcome back here with Money, and we're talking about everything that you need to keep in mind as you're setting about looking at your financial life in this new financial year. It's time to answer some of the questions that you've been sending us. And the first one is a very interesting email query that we've got from Naveen. He's a working professional. He says that he's invested 10,000 rupees per month in ICICI Pru Life. It's a life stage pension scheme plan. His investments have happened since January of 2010, and he stopped it about 2.5 years back. He then goes on to say that he's completely redeemed the amount in March 2016. And here comes the twist. The gain amount, he says, or the profit is about 1 lakh rupees, and the service manager from the same insurance company has advised him to reinvest that gain amount of 1 lakh rupees, else tax will be applicable. But the problem is that he's saying that the relationship manager says the only option for reinvestment is again back in ICICI Pru Life scheme. He's given a different scheme name this time. And our viewer here wants to know if this is actually true. If not, what are his other options? Karthik, something sounds a little odd to me. Why should you be forced to reinvest, the amount of capital gains that you've made back into a scheme of the same insurance company or the same fund house?
It's very clearly visible that he's trying to sell another policy for his company, and he's trying to, achieve maybe a target or something.
Red flag, red flag.
Yes, absolutely. So this is not the best financial advice, I would say. Now, for the benefit of all the viewers, whenever you invest into a pension plan, whatever is the amount you've invested, you've obviously been taking benefit of that under your Section 80C. Whether you've exhausted that section or not completely is a secondary matter. Now, whenever you withdraw money from such a pension ULIP, the entire proceeds is taxable. So not the gain. For example, in our case, for our friend, if he's invested, say, 3.5 lakhs and his gain was 1 lakh of rupees, the entire 4.5 lakhs is going to be taxable.
So the liability is on the entire amount and not just what you've earned as profit.
Right? Okay. By investing that amount of money anywhere, you can't save any taxes. So when he files his tax returns now in July of 16, he will have to pay tax on the entire proceeds that he got from that insurance policy, which he has now closed. So that's very, very clear. There is no doubt about that. And there is no offsetting, or there is no sort of, invest into another product and you will save any taxes. He's not going to save any taxes. So the proceeds from a pension policy will go under income from other sources when you're filing your income tax return. So you're paying income tax on that. And whatever tax saving investments that you do go under Section 80C and give you the deduction under that 80C. These are completely disjoint and independent matters, and they should not be clubbed together for removal of any confusion on this.
So he has to pay tax?
110%.
No other options. All right. We'll quickly move on to the next question. I think we've got Naina Bhatt joining us on the line. She is a 52-year-old lady from Rajkot. I think she's a professional. Miss Naina, thank you so much for joining in. Aap bataiye, aapka kya question hai?
मैं ये जानना चाहती हूँ कि बिरला सन लाइफ का जो म्यूचुअल फंड में इन्वेस्टमेंट हो लाभदायी है कि नहीं है, बेनिफिशियल है कि नहीं?
आपको फंड हाउस का नाम तो पता है कि बिरला सन लाइफ है, आपको स्कीम का नाम पता है क्या?
नहीं पता है वो तो।
अच्छा, और आपको थोड़ा आइडिया होगा कि ये इक्विटी में इन्वेस्ट करती है, मतलब स्टॉक मार्केट शेयर्स में इन्वेस्ट करती है?
इक्विटी में डाला है, हाँ।
अच्छा, और थोड़ा सा लॉस है आपके पास, ओके ना कार्तिक? peculiar problem, we don't know the name of the scheme here. What would you advise?
नैना जी, आपके लिए, आपकी जानकारी के लिए, बिरला म्यूचुअल फंड की जो काफी सारी स्कीम्स हैं वो बहुत ही अच्छा प्रदर्शन दिखा रही है पिछले 10-15 सालों से, तो इसलिए निश्चिंत रहिए। इक्विटी बाजार में इन्वेस्टमेंट करने के लिए आपको कम से कम 10 से 15 साल का अगर आप टाइम फ्रेम लेके आए तो आपको एक बहुत अच्छा मुनाफा होगा, पर कम से कम 5 से 7 साल तो इन्वेस्टेड रहिए। Now, if she's saying that she has lost money, it obviously means that, and like she's already saying that about 1.5 year back is where she invested. Now, in the last 1 year, equity markets have anyways shown a negative performance, anywhere in the range of -5% to about 10%, which is pretty much justified by what she's saying anyway. So she's lost about 10% of her capital.
Okay, so patience rakhiye. That's the advice. Let's quickly move on. We have Deepak Seth, who's joining in from Mumbai. He's a professional. He's 32 years old. He says he's a retail investor, wants to start an investment in NPS, the National Pension Scheme. And I think he also has certain mutual fund questions. Deepak, hi. Thanks for joining in. So, how much money do you want to put in the NPS?
Hi, Survi. I was planning to invest another 5,000 in NPS. Sorry, would like to start with 5,000 in NPS and another 5,000 in mutual fund. That is, I'm assuming that Motilal Oswal should be good. But I don't know which fund to go for, as I already have Franklin High India Growth, and I also have invested in UTI Equity Fund.
Okay, so you know your equity investments. That's really great news. Karthik, what do you think? So he wants to split it up, 5,000 NPS, 5,000 in a Motilal fund. He likes Motilal as well.
Yes. Okay. So, Deepak, I have 2-3 observations to make for you. Number one is, see, he's doing NPS on a voluntary basis. And if you're salaried, if your employer is asking you to open an NPS account or giving you that sort of a choice, then by all means do that NPS. If you're doing it voluntary basis, then you are better off investing into these UTI equity schemes, and you are better off investing into Motilal, or for that matter, Franklin, or any other mutual fund which is open-ended. Because your returns and your profitability on that is going to be that much higher. Because remember, the best option of NPS where you have equity exposure is also capped at 50%. So it's sort of a 50-50 kind of an arrangement. Plus there is a tax incidence and all of that on the NPS. So you're in a equity mutual fund, everything is completely tax-free after 365 days of holding. So you're far better off doing that. Now with respect to your SIPs, so you're running a mid-cap fund, which is a higher growth companies kind of a fund that you are into, Franklin fund. And the other one is a large cap diversified fund. So if you're running a 50-50 portfolio right now, instead of going into something which is of a similar nature, my suggestion is, why not look at a sector? Look at FMCG, look at technology, look at pharmaceuticals, look at banking. So you know what, you have a little bit of a concentrated portfolio as well. And that might be a good idea, because then you have a little sector portfolio going for you. You have a large cap portfolio, which is the UTI equity fund, and you have a growth oriented story via the Franklin High Growth Companies fund. So this is my suggestion, and I would suggest you restructure in this fashion.
Thank you so much, Karthik, for answering all the queries and the questions. Well, before we sign out, a quick update on personal finance news. Get ready to shell out more for motor insurance. The insurance regulator has announced a hike of 10 to 40% in third-party motor insurance premiums effective the 1st of April 2016. Now, for cars below 1,000cc engine capacity like the Alto, Nano and the Kwid, the premium rates have been hiked by 40% to roughly 2,055 rupees. For compact or B-segment cars having engine capacity between 1,000 and 1,500cc, the hike is again around 40%. The hike for sedans stands at 25%. Two-wheeler insurance for bikes below 75cc and between 75cc and 150cc has been increased on an average by 9.6% and 15%. For premium category bikes like the ones that are between 150cc and 350cc engine capacity, rates have been hiked by 25%. Of course, third-party motor premiums are regulated by the insurance regulator IRDA, and they're revised yearly based on inflation and claim trends. This type of insurance is mandatory for all motor vehicles on the roads, and it covers the owner from third-party liability arising out of accidents or damage. Well, that's all we have on this edition of Money, Money, Money. Thanks for being with us. Of course, our email IDs are on your screens. Reach out, join in the conversation on Twitter. We'll be back with more next week.